Most people think if you've already got mortgages, you're done. No more room to grow, no more approvals. But that's residential thinking, because with CMHC's MLI Select program, your existing residential mortgages, they're not a limitation. I'm Darren from DK Wealth and Growth, and today, I'm going to show you how smart investors are qualifying for multi-million-dollar government-backed loans, even with multiple mortgages already on their plate. If you're new to the channel, welcome. And if you've been following along, thank you for your continued support. Stick around till the end and I'll show you the exact metrics CMHC cares about and how you can qualify even if your personal income is capped. Let's paint the picture. You've got a few rental properties. You've built up equity. But every time you go to the bank, they say, sorry, your TDS is too high. Your GDS doesn't qualify. You're already leveraged. It's frustrating because even though your rentals are cash flowing, the system still sees you as maxed out. But that's the residential model. With MLI Select, your personal income isn't the bottleneck, the property itself is. CMHC MLI Select doesn't look at your mortgage history, they look at project performance. If the property generates income, if it hits the right targets, and if you've got skin in the game, you're in. The key metric, debt coverage ratio or DCR. Your deal needs to show that rental income exceeds total expenses, including mortgage payments, by at least 10%. That's a 1.1 DCR minimum. Our projects, we structure them to hit 1.2 or higher, which makes approval smoother and cash flow stronger from day one. Now let's talk about the basics. What do you need to get started? A 5% down payment, net assets worth 25% of the property's value, and some buffer funds for contingency. So if you're looking at a $2 million sixplex, you'll need to show about $500,000 in net assets. No, that's not loose change. But if you've been in the market for a while, it's doable. And again, that's way more important than your T4. Here's why it's worth it. Insanely low rates, usually 1 to 2% lower than the big bank's 5-year fixed, locked in for 5 to 10 years, and 50-year amortization. That's 20 more years than residential loans. This is how smart investors are locking in long-term cash flow with low monthly payments. All this while everyone else is struggling with short-term variable rates. You get predictable expenses, strong rental upside, and deals that scale without adding personal liability. So if you're sitting on a few properties and thinking, I'd love to grow, but I'm stuck, you're not. You just need to switch frameworks. CMHC MLI Select was built for this moment, for investors ready to scale beyond traditional lending. But this window won't stay open. Premiums are rising, rules are tightening. If you want to lock in today's terms, you need to act before the 2026 changes roll out. If you want to see exactly how to qualify and get access to CMHC approved projects we're working on right now, click the link in the description to book a strategy call. I'm Darren from DK Wealth and Growth, and I look forward to helping you scale without limits. See you next week.